Hello and welcome to this Trades and Tutorials video. In this video, I've got a couple of really powerful topics for you. The first of which is what to do after the markets had a huge run-up, which we've had over the last 2 weeks. The second is an ETF that is coiled to explode later this week. And the third is an opportunity to learn how to find even more explosive trades. But before I get into it, let me just make sure that for those of you who are finding this for the very first time on YouTube, please subscribe to our channel. Also know that we provide more videos like this at marketgauge.com/tutorials, as well as even more information out on Twitter at two different handles, at MarketGauge and at Market Minute. And of course, make sure you're watching this in HD. All you have to do is change your settings in the lower right hand corner. All right, so the big question right now is the S&P and the Dow have broken out to all-time highs. I talked about this in the last video, looking for industry group rotation and which groups you might focus on, how to identify them. In this video, I want to take the position that the markets are going to correct. All right, at some point they are going to correct, and when they do, one of the things you want to look for is how they pull back and how they react to the 10-day moving average, which is this magenta line. And the reason for that is because, as you can see, if by looking at almost any trending chart, once a trending chart gets above this 10-day moving average, tends to stay above it even after pulling back to it. And then once it finds its way under the 10-day, then it's a more significant pullback. And then once you get back over it, the trend tends to continue under it. Little head fake there because of Brexit. Trend tends to continue over it. Trend tends to continue. All right. So there are a couple patterns that we look for that are not specific to the 10-day moving average. But when the market pulls back to that 10-day moving average, you want to look for some really powerful either compression or flagging type patterns that enable you to define your risk, so that you can identify that the market has actually started back up and it's not going into that under the 10-day moving average phase. So I'm going to come back to that in just a second. One of the reasons that we need to be very vigilant of a pullback right now is because of a pattern that exists in the IWM. So SPYs broke out and continued to run and are at all-time highs. But IWMs, the broader measure of the market, stalled out at this 120 level. Now, yes, this is a big divergence and it's not at the major high, but that's not really my concern. That's another topic for a different video. A bigger concern is where it stalled out, which is at this 120 level, which has been so significant, and now the way that it has stalled out. So one of the patterns, and I told you we scan for patterns that are great for identifying when a market's about to make an explosive move. Now, we don't happen to scan for this particular pattern, but when you get what is now 6 days of such tight consolidation, whichever way this market goes outside of this consolidation probably will hold the key to the next significant move in the market. With one caveat, and I want you to look out for this caveat, and that is you want to see the market actually break or close outside of this consolidation and then continue to move. So you want to make sure that you don't get head faked. That requires a little bit of patience. As I said, you want it to break below this level, then you want to see it continue. Now, if it does that, then that would be my concern that we're going to see, or not concern, that would be the indication that we're going to see that pullback in the SPYs that I'm saying has got to happen at some point. The pullback in the SPYs is a good thing. The pullback in the IWMs, while not a bad thing, is probably not necessarily the best place to be looking for an entry, because the SPYs are just so strong, and the stocks, and there's so many strong stocks out there. Focus on the stronger ones. Now, IWMs is the only, well, I shouldn't say that. The Dow looks like this too. Let's take a look at the Dow. It's not 6 days, but you can see we're now going on 4 days of just sideways flat action. Action that you can box in very easily, as I'd call it. SPYs kind of going on 4 days, really 3 days at this point. Qs continuing to kind of just chug higher. So IWMs is the one I would keep an eye on. Now, in addition to IWMs, there's another ETF out there, the home builders. Actually, there's two. There's the XHB, which has this similar pattern as IWM, but sitting right on top of its resistance level. And there is the ITB. Now, the ITB is the one I want to focus on. This is the one that's likely to have a pretty significant move this week, and here's the reason why. One, you've got this multi-day consolidation. Two, you're sitting at major highs in this case. I don't know if they're close to all-time highs, but certainly highs from a very long time. It could be near all, no, nowhere near all-time highs, sorry. But this goes back to 09, certainly that high since 09. So there's a weekly chart. We look at the daily chart. There's a compression. It's much stronger than the XHB. Now, that is in part because this particular index or ETF is very concentrated. So it's always a good idea to look at the stocks underlying the ETF and see if they are heavily weighted. So in this case, the top 3 stocks make up 30% of this ETF. If we go to the top 5, you're talking about 43% of this ETF is the top 5 stocks. Now, 3 out of those 5 stocks are going to announce earnings on the 21st. So in just a day or two, this thing is going to have 30%, roughly 30% of its stocks announce earnings. So not all ETFs shield you from earning surprises. That could be a good or a bad thing. So just quickly, the most heavily weighted index in here, or stock in here, is DHI. It's been strong. This is 12% of the index. And while I'm not so sure I'd be eager to be buying DHI up here, if the earnings of these individual stocks are strong, the ETF could offer an opportunity to be a little bit more diversified and catch the breakout of the ETF. So that's DHI. The next one is second biggest is Lennar, and that one is not sitting at all-time highs, but or near its, I should say, 2009 highs. But it is sitting at a great place for it to break out from. Had a nice run up, has consolidated. Again, when you see 6-7 days of consolidation like this, expect a big move. Now, NVR is the 3rd largest, and it's 8%. So there's your 30% of this index. Now, this thing has also been a really strong stock. I mean, this is why this ETF has been so strong. All of these are positioned so that if their earnings do come out strong and the price action confirms and moves higher, this ETF could really roar. Now, if the earnings come out mixed, the ETF is still set up potentially to move higher, of course, if it does break out. So the 4th one is PHM. This one is not really in a place that is easily defined as an inflection point, but you've got the same consolidation pattern. And Toll, which is, so Toll is not reporting until August. PHM, which I just showed you, reports on the 21st. NVR reports on the 21st, and DHI, the strongest of them, reports on the 21st. So Toll is not until August. But here's the summary. All of these stocks, I would say with the exception of Toll, have had a nice move up, and they're either tightly wound up or, in the case of NVR, flagging back into support. So the setup is very conducive to a explosive move to the upside if earnings enables it. So keep an eye out for that pattern for those stocks, And if you're interested in more patterns like this that are actually even easier to identify, that lead to explosive moves with or without, certainly without, I should say, or even with the assistance of earnings, there should be a link to a live presentation that we're doing this week, which is entitled How to Find Explosive Trades in All Market Conditions. So hope this helps, and I'll see you in the next video.